Peter Keehn, thanks so much for joining us here at SuperInvestor.
Glad to be here.
You were discussing on your panel earlier blind pool and different structures of investment as well. So talk me through that and what the state of play is in this market for that pool.
Sure. Well, the blind pool structure is the traditional structure, the one that's been around the longest and the most tested at this point. And I think the point I made is for lots and lots of investors, it probably remains the best structure there is. It allows an investor to come in with relative ease, to get blind pool exposure, to not need to make investment decisions themselves, to get the benefits of diversification. And for a lot of people at earlier points, and even some at more advanced points in the development of their private equity programs, it's a very good tool, and I think it's so well accepted, it'll be around forever or for the foreseeable future. For some investors who choose to take a little more underwriting risk, those investors who are concerned about some of the time constraints associated with funds, those who've got more capabilities, we're just seeing in the market now as the market matures, some other alternative structures pop up. The first probably directional moves were basic co-investments, which allowed an investor to put capital into one single transaction, have a point of view on that transaction, help to work down their fee structure, although of course they're taking more risk because they're making a second investment, so you got to be able to handle that. But what we've seen and what we are very much a part of now is an effort to just move further beyond that and work with talented managers who may not have a fund, may choose not to have a fund, may want to raise a fund but not in a position to do that yet.
And you've done that very recently.
Yeah, we have. And there's a group that here in Europe that we worked with for a long time, got to know them very well, did some deals very closely with them. They are now in the market raising a fund, and we are their anchor investor, and we're very excited to be anchoring that initiative for them.
And there are voices saying that there should be big rewards for that, for being willing to be the one that goes out there and does those anchoring deals.
That's right, and certainly when you take on an anchoring transaction, you are taking a different set of risks. There are typically not investments in the fund, so it's a blind pool. There are not other investors to look to and whose work you can sort of draft off of. It is your own work that you're looking at. And again, that's why I say teams need to be set up to be able to do that. Not everybody is, but that's something that we're looking to do more and more of because there are rewards available for taking that extra risk.
So rewards and different structures. One of the big key themes on the panel you were on particularly was the fees question, which is always going to be a regular one. What would you say about that and what the sort of general feeling is about fees at the moment?
Yeah, I think cost of ownership in this asset class is a big issue. At the end of the day, investors in our seat, limited partners or institutional investors, are rewarded for finding opportunities to generate the best returns net back to their clients. But along the way, there's an increased focus on the gross to net spread, the gross return of the deal that the manager is generating back down to the investor returns. Gross to net returns, have been unusually high in private equity for a long time. I think there's a greater focus now on that cost of ownership in private equity as compared to other forms of institutional investment management, where the cost of ownership is much lower. And so there's much more of an effort now for investors to reduce those fees. The most basic or straightforward efforts are around the fees on the actual fund itself, and clearly there's been great progress made on reductions in management fees, in some cases reductions in carried interest, particularly the bleeding out of ancillary fees and things like that were creating a misalignment in addition to a high cost of ownership. Those all apply at the fund level, and every investor can benefit from those. But there are other initiatives, co-investment and things like that.
So you talked there a bit about misalignment. I mean, alignment is a big buzzword at the moment
I
as
made
well.
the point that if a manager is generating enough excess net income or net profit from their management company, that they can monetize that stream through going public or things like that, that's probably a sign that there may be excess return coming off of just simply the creation of management fees. And that, our view is, that does create a misalignment. When this business was started a long time ago, the 2% management fee was created really as a way to cover the operating costs of what were typically small groups of people managing very small pools of money. 50, 100, 150 million dollars was a big fund. And the 2% never came down as fund sizes went up, but really the goal originally was for the carried interest to be the incentive, the thing that created the alignment. And with the passage of time, as funds got bigger, certainly the operating costs of managers have gone up as their teams have gotten bigger, better staffed, better equipped. Regulatory costs and other costs have crept into, and so clearly the cost to run the management company of a private equity firm is higher today than it was in the past. But at the same time, that 2% number is just kind of a carryover. And there is a bit of a call now towards budget-based efforts around management fees as well. And we're looking at a couple different transactions right now, club-type arrangements, where that's exactly the way the manager would be compensated along the way, is really in a way that make sure they have enough money to attract and retain a team, operate the business, not have to worry about whether or not to go do due diligence on a deal or something like that, but not to have the management company in and of itself become a source of profit.
You talked there about getting the right team and management. That's a very important thing as well, and you talked a lot about succession planning and having the right team. It's something you think is key.
Oh yeah, absolutely. And at this point in the life cycle of this industry too, there are so many very successful private equity firms. I think at this point most everyone has faced succession in some form or another. Sometimes what that's led to is a natural and orderly transition of management. As investors in long-term vehicles, we love to see that. In some cases, the transitions have been less elegant. In some cases, it's created opportunity for us as well in the form of spin-out teams who, for whatever reason, as a transition happened or didn't happen, groups of investors within some of the great management companies have elected to go back to their roots or step out for some other reason, and that does create, in some cases, anchoring opportunities for us.
Stephen was on your panel and he's quite outspoken earlier. Do you think that's good to hear people in the industry saying stuff that other people are a bit cautious to say?
Oh, absolutely. You know, this industry is accused sometimes of being a little too myopic, or we are too much, all aligned with the same view. And I think that's a dangerous thing in any business. So it's great to have a collection of voices and to have those voices be heard. I mean, that's how. That's where good thinking comes from, and sometimes great new initiatives, get led out of things like that.
Embracing some evolution.
Absolutely,
perhaps.
right. And I think as somebody mentioned in a panel yesterday, and we feel this way certainly about managers, we always want to see, to the extent we are following a manager through a long period of time, and some of the names, in our portfolio, we've been investors with them for 15 years or more. You always want to see an element of evolution. It's when you see elements of revolution that you need to look very closely, and we'd agree with that statement very much.
Peter, thanks so much for
absolutely.
joining us.
Thank you. Nice to see you.
You too.